The world of cryptocurrencies has captured the imaginations of investors and the general public. But is this craze sustainable? Despite the crypto boom, local leaders have largely remained cautious on the subject. This could be due to regulatory hurdles or prevailing economic circumstances. While Bitcoin remains the king of cryptocurrency, new entrants like Dogecoin, which started as a meme but now is a billion-dollar digital currency, are gaining popularity. The future of money. In a matter of years, cryptocurrencies have gone from digital novelties to trillion-dollar technologies with the power to upend global financial systems. They are now held as investments and used to buy a wide range of products, from software to virtual real estate to illegal drugs. But the crypto space is fragmented and prone to wild fluctuations that have made it difficult for investors and consumers alike to navigate. This is the story of a new monetary frontier, one that will shape how people invest, spend, and even think about money. It will test the limits of technology and challenge long-held assumptions about the nature of money and its role in the economy. And it will force many traditional businesses to rethink their strategies or risk being left behind by a market that is rewriting the rules of finance and culture as we know them. The crypto craze has captured the attention of celebrities, athletes, and news anchors, as well as investors and ordinary consumers who are trying to cash in on the next big thing. It's also caught the eye of policymakers, who have rushed to respond to rising consumer interest in cryptocurrencies by ramping up regulatory actions and considering new laws. As the world approaches a tipping point in which cash phases out and digital currencies reign supreme, governments will have to find ways to manage this shift with maximum benefits and minimum risks. To address these challenges, the Brookings-Hutchins Center on Fiscal and Monetary Policy recently hosted a virtual conversation between Prasad and Glenn Hutchins, co-chair of the Brookings Board of Trustees. The conversation centered around the growing popularity of stablecoins, a new class of cryptocurrency that promises to be less volatile than Bitcoin. But it's not clear how well these new coins will do as a medium of exchange, where people use them to buy things like coffee or rent apartments. For instance, many experts worry that stablecoins could be used to fund illicit activities because they can be sent quickly and anonymously across borders, and even beyond the reach of government regulators. The future of technology. Technology, in its various forms, is the cornerstone of our world today. It's not just about making products faster, cheaper and better, it's also about changing the way we live and work. Technology is a powerful engine for economic growth, but it's not always clear which industries will benefit the most and who will be left behind. As the pace of change continues to accelerate, many economists believe we are on the edge of a digital transformation. This is the moment when a technology transforms its application beyond the original purpose and into the wider market, boosting productivity in new ways across sectors, industries, and economies. Only 3 technologies have earned this distinction: the steam engine, electricity generators, and the printing press. This shift to the third age of technology is being driven by consumers as well as businesses, with each having different needs and interests. Consumers want more control and transparency, while businesses are looking to increase efficiency and lower costs. The most disruptive technology is often one that reimagines the fundamental building blocks of an industry, with radical implications for jobs, skills, and wages. The rapid rise of cryptocurrency is a sign that we're in the early stages of this technological transformation. But, despite its meteoric gains, it's important to remember that the crypto bubble has a lot in common with past technology crazes. In 2000, the dot-com bubble sparked a rush to invest in technology stocks and real estate, and that was followed by a painful bust that resulted in massive losses for many investors. While some investors are predicting a crypto winter, history suggests that cryptocurrencies will rebound when the market recovers from its current slump. In fact, the emergence of blockchain technology has already begun to change many industries and business models. In the future, a new generation of technology will revolutionize the economy and our lives in unprecedented ways. For example, by 2025, SpaceX will have launched a crewed mission to Mars using its Starship and Super Heavy rockets, while DNA testing could reveal the genetic factors behind cognitive disorders. And, by 2030, quantum computers with 1 million bits will be available, enabling brain-computer interfaces to allow people to control their actions through thought alone, as well as providing secure methods of transmitting data that cannot be intercepted or hacked. The future of finance. In the span of a few years, cryptocurrencies have gone from digital novelties to trillion-dollar technologies. Their popularity stems from their decentralized nature, which allows them to be transferred quickly and anonymously, even across borders. As a result, they have become popular among dissidents in authoritarian countries who use them to raise funds or circumvent state sanctions. They have also been embraced by investors looking for higher returns on their investments, as well as retail and institutional players that are seeking to gain a foothold in the market. However, the rapid rise of cryptocurrencies and DeFi enterprises has raised concerns about fraud, tax evasion, cybersecurity, and their effect on broader financial stability. Many of these risks stem from the fact that they operate outside the scope of traditional finance, which is often poorly regulated. As a result, they can be difficult to value accurately and are subject to wild price fluctuations. Additionally, they are vulnerable to hacking and can be used for illegal activities such as money laundering or financing terrorism. While some governments have taken a hands-off approach to crypto, its rapid growth has forced regulators around the world to begin crafting rules for this emerging sector. They face the challenge of limiting traditional financial risks without stifling innovation and attracting the interest of new investors. One of the most important emerging trends in the future of finance is open banking, which will allow consumers to easily share their data with financial services providers and other businesses. This will enable a number of new services, such as personalized financial advice and budgeting tools. It will also help reduce costs for banks by allowing them to access customer data more efficiently. It is impossible to predict what the future will hold for the world of finance, but it is clear that change is coming. New technologies, finance innovations, and business models will all impact the economy in dramatic ways. To thrive in this new landscape, companies must adopt a flexible and innovative mindset that is prepared to adapt to changing conditions. The future of business. Cryptocurrencies and the underlying blockchain technology hold the promise of revolutionizing industries beyond finance. From supply chain management to voting systems, these decentralized networks could help create a more transparent and efficient world. However, these technologies also come with a number of risks. For those seeking to take advantage of the opportunities that crypto offers, staying informed is essential. As cryptocurrencies continue to grow from digital novelties to trillion-dollar technologies, understanding them is vital. From understanding blockchain terminology to understanding the basics of investing, it is important for investors and consumers to keep up with the latest developments in the cryptocurrency space. Despite their rapid rise and the potential for huge financial gains, cryptocurrencies remain volatile investments. The market has already experienced several booms and busts, including the spectacular collapse of Sam Bankman-Fried's FTX exchange in November 2022, which sent Bitcoin prices and other crypto values plummeting. This volatility has created a difficult environment for new and potential investors, who have been left with huge losses in their crypto investments. In the short term, the crypto boom has resulted in significant job and startup growth in a small number of metro areas that have had pre-existing tech or finance hubs to begin with. These places include New York, San Francisco, and the Miami and Tampa, Florida, metro areas, which are among the few that have seen at least partial rebounds in crypto-related activity since January of this year. However, these crypto-related activities have generally been accompanied by troubling pollution and energy costs, failed business projects, major consumer and investor losses, and an outbreak of fraud that state and local law enforcement officials struggle to curb. These problems are especially acute in places where there is little in-state regulation of the industry. As state and local leaders continue to seek ways to attract economic growth, they must carefully weigh the risks of pursuing a crypto gold rush. They must consider not only the possible negative impacts on existing businesses and residents, but also the long-term implications for the business climate in their regions.